Friday, 8:30 a.m. The jobs report drops. 172,000 jobs added. More than double what anyone expected. By any normal measure, that is great news. The Nasdaq falls 4%. The S&P drops 2.6. The Dow loses 700 points. $1.3 trillion in semiconductor market cap. Gone. In 6 hours. If you are trying to trade this market by reacting to headlines, you are already too late, and you are going to keep getting hurt. 2026 is the most headline-driven market in recent memory. Every macro data release, every Fed comment, every earnings warning from a chip company, it moves the entire market instantly. And if you don't have a framework for this environment, you're not trading, you're gambling. This is the survival guide. First, let's be clear about what's driving this. In a normal market, stocks move on fundamentals. Earnings, revenue growth, valuation. In 2026, fundamentals are taking a backseat to macro events. And those events are hitting one after another with almost no breathing room. Since January, this market has been whipsawed by tariff announcements, the Iran conflict, and oil above $100, a hot February CPI that killed rate cut hopes, a weak April jobs report that briefly revived them, a Nasdaq that fell more than 4% on one Broadcom earnings call, and now a blowout May NFP that has traders fully pricing in a rate hike by December. JP Morgan has said publicly that markets in 2026 are extremely sensitive to headlines, both positive and negative. That's not going to change. The Fed hasn't cut rates, inflation isn't at target, geopolitical risk is elevated, and the AI trade has shifted from pure euphoria to show-me-the-returns skepticism. What this means for you, the old rules don't apply. Buying the dip on fundamentals works until a macro headline creates a new dip that is 40% lower. You need a different operating framework for this environment. The first rule of surviving a headline-driven market is to know what regime you are in before you make any trade. There are two regimes, high volatility and low volatility, and they require completely different approaches. Your primary tool for this is the VIX, the CBOE Volatility Index. When VIX is below 15, the market is calm. Breakout strategies and trend following work well. You can size up. When VIX is above 20, you are in a high volatility regime. Mean reversion becomes more reliable than momentum. And when VIX spikes above 30, you reduce size, widen stops, or step aside entirely. Right now, VIX has been oscillating between 16 and 28 all year, swinging from complacency to fear and back again every time a new headline drops. That oscillation itself is the signal. It tells you this is not a trending market. It is a range-bound, event-driven market. And trading it like a trending market is how accounts get blown up. The second rule: every major headline in this market is scheduled in advance. Non-farm payrolls, CPI, Fed meetings, earnings dates, treasury auctions. These are not surprises. They are on the calendar weeks ahead of time. The surprise is only the number. The event itself is known. This is your edge. You can prepare for these events instead of reacting to them. Here's how professional traders use the macro calendar. Before a major event, they reduce position size. They don't know which way the number will break, so they don't bet big in either direction. After the number drops, they wait, not 5 minutes, 15 to 30 minutes, for the initial volatility to settle and a direction to establish itself. Then they enter in the direction of the move, not against it. The traders who got hurt on Friday were the ones who were already fully loaded into tech and semis going into the jobs number. The traders who survived were the ones who had trimmed exposure heading into 8:30 and had cash ready to deploy into the post-print direction. Know your calendar. Reduce before, react after. Rule 3 is the hardest one to execute, but the most profitable. Stop chasing headlines and start pre-positioning for the resolution. Here's what chasing looks like. A headline drops. The market moves. You see the move, you feel the FOMO, and you buy in. At the high, after the first wave. The market reverses. You are now down, and you either panic sell at the low or hold and wait while the position grinds against you. Every retail trader has done this. The market is specifically designed to make this feel like the right move. Pre-positioning looks different. You identify the most likely scenarios before the event. You decide which one you will act on and at what level. You set your alerts. And when the market gives you that level, you act. Not because you saw the headline first, but because you had already done the work. For the CPI release on June 10th, the pre-positioning trade is simple. If CPI comes in hot, above 3.5%, the rate hike narrative accelerates. Tech and semis face another leg down. The trade is to have that thesis ready and a level identified before 8:30, not after. Pre-positioning doesn't mean predicting, it means preparing. Rule 4 is simple, but most traders ignore it in the heat of the moment. In a high-volatility, headline-driven market, your position size is your primary risk management tool. When the market is swinging 3 to 4% on a single data release, a full-size position in the wrong direction can do in one session what a bad month used to do. The math is brutal. The professional response is to cut your normal position size by 30 to 50% during peak headline risk periods. You are not giving up opportunity. You are buying survival. A smaller position keeps you rational. It lets you hold through the initial volatility without panic selling at the bottom. And it keeps you in the game to trade the next setup. Dry powder is not weakness. In this market, having cash when everyone else is frozen is one of the most powerful positions you can be in. Here's your headline calendar for the next 2 weeks, and how to think about each one. June 10th, CPI. This is the big one. If May inflation comes in above expectations after a blowout jobs number, the Fed rate hike narrative goes from probable to near certain. Tech and semis would be the most exposed. Reduce before 8:30, watch the 15-minute bar after the release, and trade the direction. Not your prediction. June 17th. Fed meeting. Chair. Kevin Warsh speaks for the first time after a blowout jobs number. With the rate hike narrative now fully in play, every word about the rate path matters. Markets will reprice instantly on any hint of a hike timeline. Same approach. Know your scenarios in advance. Ongoing, semiconductor guidance. Broadcom cracked the dam on Friday. Any additional soft AI demand guidance from NVIDIA, AMD, or Marvel reopens the downside in the Nasdaq. Watch earnings calls, not just the numbers. The market is going to keep throwing headlines at you. That's not changing. What can change is how you respond to them. The traders who survive headline-driven markets aren't the ones who see the news first. They're the ones who already have a plan when the news hits. Know your regime. Own your calendar. Pre-position. Manage your size. And never chase a move that's already happened. If this framework helps you navigate what is coming, hit subscribe. New market analysis every week on Black Bear Trading. TradingView and TickerOn links are in the description. Both essential tools for tracking these macro setups in real time. Educational content only, not investment advice. Trading involves risk. Do your own research before making any decisions. Stay disciplined. I'll see you next week.